Mergers and Acquisitions, Allied Colloids, SIBA, and Hercules by Julia Planamore. Number 1. What caused Allied Colloids to become a takeover target? Allied Colloids was viewed as an attractive takeover possibility because of its strong market share in a niche industry. Its technology was used in the water treatment, textile, and paper industry. Many companies were very interested in acquiring this technology in order to diversify their business and make it easier and cheaper to comply with environmental requirements. Another aspect that positions Allied Colloid as a takeover target is its possible expandable margins. The industry had been going through a major period of cost cutting and rationalization. Allied Colloids had been implementing efficiency policies in order to reduce costs. This would increase the company's revenue and allow for economies of scale. Allied Colloids was criticized to have been performing below expectations. The company was harmed by the strengthening of the pound in 1997, which decreased the amount of sales it had in that year. Secondly, Hercules, chairman and chief executive, strongly criticized Allied Colloids for having had a poor share price performance and had underperformed the stock market by 38% over the last 3 years. Also, Allied Colloids had acquired CPS, a U.S. producer of water-soluble polymers, winning against Hercules, who also wanted to buy the company. Therefore, besides also wanting to diversify its operations into the water treatment business, Hercules was desperate to acquire Allied Colloid and consequently take over as well. Number 2. How did SIBA value the gains from the merger? SIBA's specific reasons to target Allied Colloids were highly correlated to its strategic plan. The first aspect SIBA plans to achieve is to build on its global market position by growing businesses outside Switzerland. Therefore, by acquiring Allied Colloids, it would successfully reach the United Kingdom, improving its market reach and enabling for higher profit margins. Also, SIBA aims to focus on high value-added products and services by focusing in distinguishing itself through product diversification. By acquiring Allied Colloids, SIBA would engage in the water treatment chemical businesses, providing a high value-added franchise and complementing their specialty chemical portfolio. Another objective of SIBA is to always promote and accelerate innovations which come from improvements in key processes, including R&D. Allied Colloids had a material investment in R&D. It cost SIBA 1 billion Swiss francs to acquire the target company's in-process R&D. SIBA is also committed to achieving excellence through continuous efficiency improvements. Allied Colloids will provide SIBA with a high growth potential, a reputation of innovation and technological leadership, and better profit margins. Also, acquiring Allied Colloids should improve SIBA's costs. The company, which is closer to Allied Colloids market and already employs 2,000 people in the UK, should experience higher cost savings. Moreover, SIBA is still expected to pursue Allied Colloids cost savings policies. Lastly, the integration of Allied Colloids should show cost synergies of around 50 million Swiss francs per year, which represents savings in operating costs. SIBA believed it would benefit from Allied Colloids' workforce, technology, and expertise. SIBA announced that it would not cut jobs after the merger and it would keep the original workforce. In fact, Allied's chief executive David Ferrer would become the head of the new division. After the merger was fulfilled, SIBA argues that the net present value of the acquisition was positive. By increasing its debt and becoming more levered, the company was able to reach its debt-to-equity ratio and reduce the overall WACC. Also, due to the large cost of the acquisition, SIBA expected to see positive results starting only after 1999. In the first year, 1998, EPS would be diluted. However, it would start increasing after 1999. Economic profits should also be diluted during the first year and increase afterwards. Moreover, because of extraordinary charges related to the acquisition, SIBA should experience a net loss in the first half of the year. Number 3. What effect did the acquisition have on SIBA's balance sheet and performance? The acquisition had an immediate negative effect on SIBA. With the merger, SIBA was able to increase its goodwill by over 2 billion Swiss franc. However, the deal was financed based solely on debt. SIBA's long-term debt increased by more than 3 billion Swiss franc. Therefore, the cost outweighed the amount of goodwill incorporated. Also, shareholders' equity decreased by 24%. According to the company's annual finance report for 1998, this happened because of the decrease in retained earnings due to the one-time write-off of in-process research and development costs. Since SIBA did not issue any more stocks to finance the deal, its total number of outstanding shares stayed the same. Therefore, a decreasing value of retained earnings divided by the same amount of shares resulted in a decreasing earnings per share ratio. Velocity is calculated by dividing net sales by invested capital. The acquisition led to a 20% increase on average invested capital. Sales increase was only 8% in 1998, which was not sufficient to compensate for the large investment. Therefore, velocity decreased to 0.83 in 1998 compared to 0.97 in 1997. In 1998, SIBA experienced a net income loss of 270 million Swiss franc. As said before, sales increased by 8%. However, selling, general, and administrative expenses increased by 11% compared to the previous year. Goodwill amortization also had a major impact in increasing expenses. Lastly, the last major aspect that impacted net income was net restructuring and special charges. 4. Who won, who lost? The first, most obvious loser in this deal was Hercules, who got outbid by SIBA and did not get to merge with Alloid Colloids. Another loser in the situation was actually Alloid Colloids employees. Towards the end of 1998, SIBA announced a skill concentration program that would cut around 1,000 jobs at the new division. Also, at the beginning of 1999, David Farmer, former chief executive of Alloid Colloids and a member of SIBA's board of directors, resigned his position with SIBA. Even though he argues his decision had nothing to do with SIBA's performance, he can be considered a loser in the situation, given there is always the question of if he would have left his job if Alloid Colloid still existed. SIBA can also be considered a loser in the deal in the short run. SIBA's performance and earnings decreased deeply in 1 year period due to the acquisition. Because of this, in the first quarter of 1999, Moody's Investor Services stated that it was reviewing SIBA's rating for a possible downgrade. SIBA can also be considered a winner, especially in the long run. SIBA was able to enter a niche market and retain a material market share of it, given that Alloid Colloid was one of the leaders in the market. It was also able to diversify its operation and constantly increase net sales over time. Also, SIBA increased its leverage by the issuance of debt, and it was able to achieve its optimal debt-to-equity ratio, decreasing its overall cost of capital. Alloid Colloid's shareholders are also considered winners. SIBA paid a huge premium for all the outstanding shares it bought. All this extra profit went straight to the shareholders that sold their shares to SIBA. Number 5. Postscript. For SIBA, net sales, operating income, and net income and earnings per share rose compared to 1999. In this time period, it is possible to see that total assets increased in magnitude when compared to 1997, when SIBA had not yet acquired Alloid Colloids. Total liabilities increased dramatically from before the acquisition. Also, shareholders' equity decreased and had not yet reached the same level as 1997. SIBA's stock price was majorly affected by the transaction. It continually decreased over the years, reaching around 37 Swiss francs per share in 2008. In the same year, SIBA was acquired by BASF for 50 Swiss francs a share, which represents a 32% premium. Regarding Hercules, after the failed attempt to acquire Alloid Colloids, Morgan Stanley downgraded the company from its strong buy status. Also, many analysts took the company out of their recommendations list.